Part two of our adjustment on the accrual accounting system. When you have an accrual accounting system, there is a need to make what's known as adjusting entries at the end of each accounting period. These adjusting entries are journal entries made at the end of the accounting period in order to update our accounting records. When you're making adjusting entries, you're going to do one or two things. You're either going to recognize revenue or you're going to recognize and record an expense. In essence, what we're saying here is that we want to make sure that all revenue that has been earned in the accounting period has been recorded, and any expenses related to the recognition of revenue have been recorded in the accounting period as well. Okay? So whenever you make an adjustment entry, here's a rule. Write this down. When you make an adjustment entry, you're going to either increase a revenue account or you're going to increase an expense account. When you're making an adjusting entry, it will always include one account from the income statement and one account from the balance sheet. So remember those rules. When making adjusting entries, you're going to either increase a revenue account or increase an expense account. You're going to include one account from the income statement and one account from the balance sheet. Okay? So adjusting entries are made to ensure that D, all of the above, that expenses are recognized in the period in which they are incurred, that revenue is recognized when the performance obligation has been satisfied, to make sure that balance sheet and income statement accounts have the correct balance at the end of the accounting period. Okay? Now, there are different types of adjusting entries, what we call deferrals and what we call accruals. When you think about deferral, think about something has been delayed. We have delayed the recognition of an expense or revenue, and we're now going to make an adjustment to recognize that expense or revenue amount. When you have an accrual, it means that the revenue or expense has already taken place, but it has not yet been recorded. All right? So with our deferrals, we have what's known as prepaid expenses. You know what those are, right? Prepaid expenses are really assets. It means an expense was paid for in advance. Whether we're talking about prepaid rent, prepaid advertising, prepaid insurance, supplies, examples of prepaid expenses. So the question is, these are expenses again, paid for in advance. What happens once the expense becomes due? At that point, they are no longer prepaid. They now become an expense. So when making these adjustments, we're going to decrease the prepaid expense account, which is an asset, and recognize the actual expense. Unearned revenue means cash received before services are performed. It means that someone has paid for a service or product before they receive the actual service or product. So example may be if you're planning to fly somewhere, I'm not, but maybe you are, and you purchase your airline ticket in advance. For the airline industry, that is known as unearned revenue. The adjustment says what portion of the unearned revenue have we earned by the end of the accounting period? We'll take a look at those types of adjustments. Next up, we look at accrued revenues and accrued expenses. Accrued revenue again means the revenue has been earned, however, it has not yet been recognized. So we'll take a look at how do we recognize accrued revenue, accrued expense or expenses that have already incurred, however, they have not yet been paid, nor have they been recognized or recorded as well. So we'll take a look at how do you recognize your accrued expenses as well. Okay, you ready? Let's go to work. Here we see a trial balance, okay? And this is a trial balance before we've made adjustments at the end of the accounting period. So before I can prepare my financial statements, I have to make my adjustments that we'll take a look at, and we'll then prepare what's known as an adjusted trial balance, which will now show each account's correct in a balance. So the balance you see here, these are balances before adjustments. We're then going to make some adjusting entries and make sure that every account has been updated before we prepare our financial statements. Okay. So here's what we call the accounting cycle, where we go from analyzing business transactions, record them in the journal, post them to the appropriate ledger accounts, prepare us on the trial balance. We're now at this stage, journalizing and posting adjusting entries. So right now we're on the fifth step of what's known as the accounting cycle. So we're going to look at adjustments for what we call prepaid expenses or unearned revenue adjustments. The best way to teach this concept is by going through some actual examples. So once again, if I pay for my insurance, my rent, or advertising in advance, those are known as prepaid expenses, meaning that cash was paid before the expense has been recognized or recorded. So when you make the adjustment says what portion of the prepaid expense has now become an expense. When you make the adjustment for prepaid expenses, we're going to increase or debit an expense account in order to recognize the actual expense, and we're going to credit the asset account, which is going to be the prepaid expense. Because a prepaid expense is only an asset because it was paid for in advance. Once the amount becomes due, that portion is no longer prepaid. It now becomes an expense. Okay? Let's just get into some examples. We have the Sierra Corporation. They bought supplies costing $2,500 on October the 5th. So when they bought the supplies, they would debit the supplies account and either credit cash or accounts payable. The supplies account shows the balance of $2,500 on the October 31st trial balance. An inventory count at the close of business on October 31st reveals that 1,000 of supplies are still on hand. So what are we saying? We're saying that on October the 5th, we bought supplies at a total cost of $2,500, and we increased or debit the supplies account. But now it's October 31st. We're now at the end of the accounting period. Supplies remain only total $1,000. What does that mean? That means supplies decreased by $1,500. Once those supplies have been used, that cost now becomes an expense. Because right now we're showing $2,500, in our supplies account on the trial balance, when the actual amount should only be $1,000 after we make the required adjustment. Now, once supplies have been used, that portion of the cost now becomes an expense. So when making the adjustment entry, we'll debit supplies expense for $1,500, credit our supplies account for $1,500. So once you make the adjustment, now our supplies ledger is showing the correct balance of $1,000 as of October 31st, and supplies expense is being debited for the amount of $1,500. So when making the adjustment, and remember, you will always increase an expense account or a revenue account. When making the adjustment, it consists of one account from the income statement, one account from the balance sheet. Or another, gotcha. On October 4th, we paid $600 for a 1-year fire insurance policy. All right. The coverage begins on October the 1st. Now, this is a 1-year insurance policy. On October 31st, we have to make an adjusting entry. The adjustment says how much of that $600 that we paid on October 4th has now been used up. Now, keep in mind that on October 4th, we debited prepaid insurance in the amount of $600 on October the 4th, okay? But again, it is now October 31st, and we have to make an adjusting entry. The adjustment shows again what portion of the prepaid insurance has now been used or consumed. So, the $600 covers insurance for 12 or for 1 year or 12 months, which means the amount is going to expire at a rate of $50 per month. So for the adjustment entry, we'll debit insurance expense for $50, credit prepaid insurance for $50. So now in the prepaid insurance account, after the adjustment, the ledger is showing a remaining balance of $550. So we're going to adjust this account every month, this same adjustment entry for the next 11 months. Depreciation is a system or a process of allocating the cost of an asset to an expense account over the asset's useful life. What does that mean? It means when you have what we call long-term, long-lived assets, such as buildings, machinery, automobiles, the cost of these assets will become an expense over time through a process known as depreciation. So, we are required in accounting to make an adjusting entry to show what portion of the asset's cost we're going to depreciate at the end of each accounting period. So here we have office equipment that's going to depreciate. It says $480 a year. But again, we're doing it only for the month of October. So $480 a year will only be $40 per month. So we're making the adjusting entry. We would debit the expense account for $40, credit the contra asset account known as accumulated depreciation. Because each accounting period, a portion of the equipment's cost becomes an expense through a process known as depreciation. So the contra asset account will show how much of the cost has been depreciated so far. Okay? So stay tuned as we're going to cover some additional type of adjusting entries in the next section of our Chapter 4 video lecture.